only the people in the audience do. And for those who are on the webinar, you'll be seeing a set of polling questions which we would like you to fill out, and we will collect that information and talk about it. It's basically a profile on those who are participating, organizations they're from, their interest in green bonds, and sometimes the countries where they're from also. But today's next very exciting discussion, and I recognize some people in the audience too, because what we're going to be talking about are a new set of financial instruments that has really increased over the last few years with regard to a way of financing climate change, i.e. mitigation and adaptation. And what's important here is the CEADIR Series is a 4.5-year project. We're 1 year in. It goes through the September 2018. And what we're excited about is that it has two major areas. One, as the name implies, the climate economic analysis for development, investment, and resilience. We focus a lot on economic analysis and the best practices for doing good economic analyses of your mitigation, adaptation, interventions, or actions. But we also focus on financing. And if you've been following the series, one of the themes we've had is that a significant amount of resources from the private sector are not only needed, but are in fact are being raised by the capital markets right now, anywhere from 60 to more than that % of total mitigation and adaptation funding worldwide. So we have a really great panel today that will be talking about the green bonds and how those fit into a financing instrument. And they'll just walk you through not only an overview, which is what Michèle will be talking about as our moderator too, and she's on the CEADIR project. And then there'll also be Anurag, who basically is going to be talking about a program in India, which is very exciting on green bonds and how they progressed. And what I think is really important in his talk is where he's going, what they're really going, and finding out what are the governance barriers, what are the institutional barriers to set up this new framework. As this is from the USAID India mission. And then we're going to have Berit Lindholdt talk a bit more about the green bonds from the IFC perspective and how they have really been moving in and helping to motivate this market and really putting some of the liquidity into it so that it becomes, it's taking off, as we say, or scaling up too. So with no further ado, I'll let Michèle introduce her panelist and make a presentation.
Thank you very much.
Oh, one just question. We hold questions to the end, and then we'll have a dialogue. So that's a good way of just knowing that, let the people speak. We'll hold questions afterwards.
Thanks very much. And we're really looking forward to today. As Marcy mentioned, we're going to talk about climate finance and in particular green bonds. And so what are green bonds? Probably maybe most of the people in the room know, but if not, really it's a simple debt obligation. There's not a lot of difference, and in fact, some people may say it's plain vanilla, a plain vanilla instrument, simple, delicious. The twist is that the resources, the proceeds that is, are directed towards the environment or climate change. Most green bonds out there are use of proceeds or asset-linked bonds. And so what that means is that they're financed, they're backed by the issuer's whole balance sheet. Basically, their earnings are feeding into paying back the bond. But other types include revenue bonds. The issuer could be using taxes or fees to pay back the investors, or they're project bonds where they're tied directly to a project and it's the project resources that are paying back the investor, or securitized bonds where you may have a pool of different assets that have been turned into a security and then it's that pool that's paying back. So what is the state of the market today? Well, green bonds as such, labeled as such, have been more recent, maybe since 2007, some people say, but there have been bonds that have been financing environmental issues for quite some time. But in 2007, the World Bank and EIB both issued climate change bonds, or let's say green bonds that were labeled. And since then, the growth has been enormous. Particularly in 2013, that was a landmark year. From 2012 to 2013, the issuances tripled and the outstanding market doubled. And then again in 2014, again the issuances tripled. And so just looking up the slide, you can see that 36.6 billion of labeled green bonds were issued by 73 different issuers in 2014. So what we're expecting this year in 2015 is that it could be as much as 80 or even $100 billion will be issued in labeled green bonds. And what do I mean by labeled? It's the issuer that is saying, this is a green bond. I'm going to use these proceeds and apply them to either an environmentally friendly or a climate change action-oriented type of activity. Themed bonds. So these are bonds that have been issued, and then the resources or the proceeds have been funneled into projects such as clean energy projects or other sorts of themes. Those have grown incredibly too, and as you can see, in June 2014, it was estimated to be $502.6 billion worth of climate-themed bonds outstanding. And that's from over 280 issuers. But what are those in? So most of those are in transport. Really, the almost 3/4 worth are in transport. Energy is the next sector, then climate finance, buildings and industry, waste and pollution, and water. And water, to me, surprisingly, water is the smallest sector. And as Berit and I were talking this morning, really those could be considered blue bonds, but they're really not out there yet. So behind these themes, transport. This is a photo of China, one of China's energy efficient or clean energy railways. And so rail bonds in China, UK, France have all been a type of activity that has been financed by bonds. Also, really interestingly, last year, Toyota was the first auto finance green bond. And that was a big deal. And they're expecting to see more. Tesla is financing both their cars and also their new batteries. In energy, hydro is the biggest in terms of where money is going into. There's nuclear, wind, solar. And so you can see, just I'll let you follow on your slides, that the money from these bonds is going into a number of different areas. And it continues to grow. But one of the issues is that not all of them are labeled. And so investors can't always find these bonds. They're just bonds going out there. And maybe if they know the company, or maybe because the advertising in terms, or the prospectus in terms of what the bond is going to be for, people can find it. But it's not a simple find. So what are the challenges and opportunities? One, principles and standards. So although people are labeling their bonds as green bonds, are they really using it for a green activity? And what do they consider green versus what do other people consider green? So there are principles now, the green bond principles, and that was a voluntary, that a number of different organizations came together, and following these principles is currently voluntary. Tied to that are standards. Is there a third-party verifier? So who can really verify whether these green bonds are following the principles and standards? So that's another both challenge and opportunity. There are standards being formed, like Climate Bond Initiative is forming standards, and so are others. So issuers, I mentioned all of those bonds out there. Most of those have still been, and I should go backwards. I think I had, so issuers, really it's been development banks that have been the most. They have carried 44%. Corporate is growing, though. Most recently in 2014, there was with Toyota and other corporate issuers, and also this year, there's been an increase in corporate bond issuers and corporate green bond issuers. And by municipal, I'm actually talking about subnational, because some of these are states, some of these are cities, and those are now entering the market. But not so much in developing countries. In developing countries, we have India, which we're going to be talking about, that has issued a green bond. China has recently issued a report, the China's Green Financial System, and in that there's a real push for green bonds, but they haven't yet pushed them out. Brazil is going to issue the first food industry green bond. That's soon to come. Mexico also has some renewable energy bonds that are coming out, but these are still to come. This is still new in the developing world, and yet it's an incredible source of financing that could be tapped into. Aggregation, securitization, covered bonds. Why do we mention those? A lot of these projects are small, and you can't do a bond that's of interest to institutional investors or other investors if it's too small. So aggregating these and creating a security from them is a very important method of getting financing for them. We also have to improve the risk return profile. So reducing risk would be through, say, guarantees, or a first loss lender role. Development banks can do that, governments can do that. And also there are ways to increase returns. That could be by implementing a carbon market so that there are other methods through which these projects can obtain additional money that would flow out through the bond, or feed-in tariffs. Tax incentives. So far, these bonds do not have special tax privileges. So really, it's just a straightforward bond, and a lot of times the people that are investing because of their risk profiles, but also just wanting to invest in this type of theme. So what are the future trends? Well, I mentioned making it easier for investors. We have to label the opportunities, standards, making that way investors can make sure that their money is going into things that they want to, and also they can review better the performance of their investments. If they really are wanting to have an impact, this allows them to see that. Third-party reviews. And what are the new issuers? Again, a lot of us here are interested in improving developing countries' access to finance for climate change. And so through national development banks, through yieldcos, and those are publicly traded companies that are formed to own operating assets. Also, new instruments, I mentioned pooling and aggregating, securitizing, or converting convertible bonds where they would later change to equity instruments. So although, again, it's a plain vanilla instrument, there are so many different things that one can do to enhance green bonds and to really reach the market, both the investors and the issuers. So we're really excited to hear about examples of what USAID India is doing, and also IFC. So I'm going to turn to Anurag to listen more about what's going on in India.
Okay. Thank you so much. So I'll stand and then speak. So the work which I'm going to share is from the project Pasty, which is a US-India bilateral program, and it really focuses on accelerating deployment of clean energy in India, and financing is a big piece of this program. This presentation is focused on green bonds related to renewable energy financing in India. So things are only related to renewable projects. So what is the current landscape of financing renewables in India? We have three major issues. The first is the cost of capital. We have a general trend of high interest rates in India across the sectors, and that really impacts the cost of energy which is produced from renewables. If you compare to a similar project in US or in Europe, the cost of energy is almost higher than 25 to 30% what you do in India. So that's kind of a major issue. The second issue is about the tenor. The way most of the financial institutions work in India, they raise capital for shorter duration, and that's the reason they only lend for shorter duration. So the average loan tenure would be around 5 years, whereas for renewables project, you're like for a larger duration, maybe 10 or more than 10 years of duration. So that's the second issue. That also linked to the interest rate fluctuation, because the capital is raised from the shorter duration markets, you cannot commit to a fixed interest rates, and that's the reason we have mostly interest rates which are floating interest rates, and that creates problem for investing in renewables. And because of this thing, because of having a kind of a short-term capital raise and then a requirement for a longer duration loan, most of the financial institutions get into an issue of asset liability mismatch, where your liabilities and assets don't match because of the tenure of two things. We have a kind of a near absence of bond markets, which kind of creates a situation of liquidity issues. And then we also have a regulation where the financial institutions cap their investment for individual sectors. So we have sectoral limits. And unfortunately, renewables is part of a larger portfolio of power sector. So an investor will prefer to invest into a conventional project which is less riskier compared to a renewables project. And then most of the banks or financial institutions have already reached their lending limits. So this is kind of limiting the investment into renewables. And all these issues are kind of further enhanced if you look into what is needed to meet the national targets. Recently, the Indian government has really announced the targets for solar energy from 20 gigawatt to 100 gigawatt. This is like 5 times increase in the same duration up to 2020. We also have a new wind mission which is targeting 60 gigawatt of wind by 2022. So we are clearly looking into an investment of 250 billion plus if we have to meet this target. I'm sorry. So what is the current level of investment? We have around like $6 billion annually which is invested. In the peak time of 2011, 2012, it has gone down significantly. And if we have to meet this target, we are looking around $35 to $40 billion every year up to 2020. And that's where we have to look for a kind of a new way of financing. So what USAID looked into is like what are the potential solutions and what are the key principles for identifying these solutions. One, that we really need to attract a new class of investors, especially the investors which have a kind of appetite for investing into a longer tenure projects. So we look into pension funds, sovereign wealth funds. We can also look into taking the advantage of the risk re-rating, how the a risk profile really goes down once a project is is up to kind of commission and it's not under development. The liquidity can be enhanced through listed instruments. And then how do we facilitate integrating or kind of aggregating and bundling? Michèle talked about adding a lot of projects so that you can reduce the total cost of transaction. And then enhancing the investors' confidence, what can be done about it. And that is where we have identified a number of innovative financing ideas for increasing investment in renewable energy, and green bonds is one of it. So I'm going to talk about green bonds today. So what really green bond does, looking into the financing situation in India. One, that it allows you to get a long-term debt, which is kind of a missing thing. But then it also addresses the issue of asset liability mismatch, and that is where you can look into refinancing some of the projects which are already commissioned with this low cost capital. You can also see that as Michèle showed in her slides, their renewable projects is one of the priority area for green investors. So that's where renewable energy projects can really attract investment through green bonds. They can be listed and they can also be traded bilaterally, which can enhance the liquidity issue which we have seen before. And then it really provides a lower cost, fixed interest, longer tenure and non-recourse capital, which is most of the project developers are looking for. So this is really a solution for the issues which we are facing in India. And if you really stack up the risk profile of a project which is under development and compare it with the operating asset, you will see a big difference of about 8% in both of the cases. And what is happening here is basically some of the risks are completely eliminated. For example, the land acquisition risk, because when the project is there, you don't have an issue about identifying the land or acquiring the land. some of the risks actually goes down. So for example, the technology performance risk. So once you have run the project for some years, you know how it is performing, and that really brings down the technology performance risk. And some of the risks stay at the same level, which really shows that a project which has a life of 20 to 25 years, you have higher risks at the initial phases, maybe the first 2 or 3 years, depending on the kind of technology you're working on. And then the risk profile significantly goes down. And that is where, if you can take the advantage of making this change and identifying a new sources of financing, which is like looking for this kind of a lower risk profile, we can really tackle most of the issues which we are facing in India. And that's where we see that green bonds can play a role. Most of the existing bank finance which we have in India is stuck at the stage of project development or construction. There are no exits. We have sector limits, as I mentioned before, and then you also have an issue of asset liability mismatch. And that is where green bonds can allow these financial institutions to exit these projects and then reinvest the money into new projects which are of higher risk, and they can kind of further keep this chain moving. In India, we are looking into two types of bonds, domestic bonds and international green bonds. And when I say domestic bonds, these are the bonds which are raised in country in local capital in Indian rupees, and the international green bonds are like raised globally and then mostly linked to dollars. And we have advantages of both, but then there are key challenges in raising this in India. So let me talk about the domestic green bonds. They are very easy to do, and there is no issue of currency hedging, because then you're raising in Indian rupees, you're paying back in Indian rupees. There is no impact of country rating, and that is where I will explain it in the following slide what really is the issue. And then because these projects are low risk, and we have seen that these are the lowest non-performing assets these banks have, there is an interest in kind of investing in renewables project. The challenges which we see in India is like a major issue is the lack of depth of market, the capital bond market in India, and raising any bonds locally is going to be an issue. And then again, there are limited trading opportunities for green bonds in India. For international green bonds, definitely the advantage is that you can access low cost capital from capital markets globally. The advantage also is like you can identify and work with new set of investors. You can kind of attract those new set of investors. But the challenge which we see is the first one is the hedging risk. And this can raise the cost of capital or raising bonds between 4 to 7%. We have the country rating, which is BBB minus. And then if you really want to raise a bond outside India for projects which are in India, the rating of the bond will be capped at the sovereign rating. And that is where most of the international investors look for at least a rating of AA if they are kind of looking for investing in green bonds. And this is going to be a big challenge for us. We have regulation around external commercial borrowing. And then there is a limit up to which that capital can be used for refinancing projects. So the Indian Reserve Bank actually limits that 25% of that capital can only be used for refinancing, and 75% should be used only for new projects. And if we are looking for refinancing projects through green bonds, this is going to be one of the limitations. And then you have an issue of double taxation. If the bonds are raised internationally through an SPV outside India, you will have to pay the taxes in India and then also have to pay taxes in the country where the bonds are raised. So this is going to be a challenge in raising international bonds in India. If you look into the total cost of green bonds, it's around 13.3%. It can change depending on the composition. But what you really see is the major part comes from the currency hedge cost, which is 4 to 7%, as I mentioned before. And then the second issue is about the credit risk of the country. And if you have to enhance the credit risk, you have to pay a premium on that, which is around 2.5%. And this really adds up cost for green bonds in India. And this is again kind of an issue because a project developer in India can get a debt at the rate of 13%. And this is again getting the same cost for this. So why would one prefer green bonds over local debt if it is available for them? So what we looked into, how do we reduce this, and what are the ways through which government can support green bonds and at least help reduce the cost of raising bonds in India. And we found that by having these bonds of certain fixed size, not really doing very small bonds, and by providing policy support, the cost can be reduced by 0.2 to 0.4%. If government can create an exchange rate liquidity facility, that can significantly reduce the cost by 1 to 1.4%. And then by introducing the partial risk guarantee mechanisms, again the further cost can be reduced by 0.5 to 1%. So this can really bring down the cost of green bonds to 10.5 to 11%, and which will really make them really attractive for project developers and investors in India. So we are working with Government of India under this program, and we have made certain suggestions. We are working actively with the Government of India to really further facilitate the use of green bonds in India. So one of the suggestions was to create an exchange rate a liquidity facility, and this can be kind of for a certain size or certain time frames. You don't need to really hedge everything under this thing, but then it can reduce the cost of bonds significantly. Credit enhancement, USAID has a credit guarantee program. IFC does have some of these instruments available, which can be used to further bring down the costs. And then working on the issues of refinancing and on lending restrictions for the international capital which is raised through bonds. We are working with the regulator there. One of the ideas is to really index the tariffs to inflation rates. So this can really help us reduce that cost of hedging, and this can also can be indexed to actual exchange rates. So although when we made this suggestion, nobody was kind of listening to it, but then I heard recently the Indian Power Minister spoke about indexing tariffs to exchange rates, and that is possible because we have certain types of consumers whose business is export oriented, like the special economic zones where like 100% manufacturing is export oriented. So if your business is based on exchange foreign export, your tariff can be indexed to exchange rates, and that will really help reducing the hedging risk for the green bonds. And then we can also leverage other international funds for credit guarantee. For the domestic bonds, there is a suggestion either we can kind of provide a special tax rate for certain types of investors, because in India the pension funds are exempted for any tax on the interest they earn, and if they have to pay a tax on green bonds, they will not be investing in green bonds. So that could be one of the things, or to kind of really have a special tax benefit for a general investor. So it could be a kind of a tax-free bond which can provide a benefit on an income tax for individual investors. We can further enhance the use of domestic green bonds in India. So these are the learnings from the work which we have done so far. I think green bonds does really address the challenges which we have in financing renewable energy in India. The major issue which we feel still are the hedging risk and the credit rating of the country. And if you're able to address this, I think we can really use this instrument in significantly leveraging investment for renewables in India. Thank you.
Thank you very much, Anurag. And we're going to go ahead and pass over to Berit, who works with institutional investors in climate finance and especially green bonds right now. IFC actually was one of the players that really boosted the green bond market. In 2013, IFC issued a $1 billion green bond issuance. Rumor has it, at least what I've read, is that within an hour that was sold out. And so definitely looking to hear the lessons that IFC has to share with us.
Thank you very much. Allow me to take a step back and talk a little about IFC's climate finance in general, and in particular about a report that was released just last Thursday about how to invest in a time of climate change, before I move on to talk about the green bond as an investment opportunity. So IFC is the World Bank's private sector arm. We invest in the private sector in emerging markets. And we know that climate change will be a fundamental threat in particular to the developing countries. We have estimates saying that if we are going to transform to a low carbon economy, a 2-degree world, it will require an investment between $75 and $100 billion in the emerging markets annually. So that's the reason why IFC has a priority in climate finance. We started investing in climate finance, in climate smart projects back in 2005, and we now have a portfolio about 13 billion. And in 2014, or rather the fiscal year of 14, we had almost 20% of our long-term financing going to climate smart projects. That was in a dollar amount at 2.5 billion. And it resulted in at least 5.5 million metric tons GHG emission annually, avoided emission of 5.4 million metric tons. That is equivalent to about 1 million personal vehicles off the road. However, as I mentioned, the investment needs in the developing world is quite significant, and it's more than IFC's books can have or carry on our own. So we are also talking to institutional investors, trying to engage them in the conversation about what climate risk means to their investment portfolio, but also how they can invest in a more climate safe or climate resilient way. In 2011, Mercer published a report on climate change scenarios, implications for strategic asset allocations. It was showing what the climate change means for long-term investors, and it actually showed that there can be a significant impact on the value of the portfolio. So last year, Mercer got together with 16 major asset owners from across Australia, Europe, and US. These guys representing about 1.5 trillion in assets under management, and they decided to do an update of the 2011 report. The reason for doing that is that in the meantime, the IPCC has released a new report with new data that shows that the probability, the timing, and the magnitude is much bigger than what was used for the 2011 report. This study was supported by IFC in partnership with the German BMZ and the UK AID. Using the latest scientific data for this new report, they have been able to quantify the potential impact of climate change on a sector level, but also an asset class level. So while the timing and the magnitude of the climate change impact still are uncertain, we now know enough for the investment fiduciaries to actually have a think about climate risk in their risk management. We think that this study will help investors identify climate risk in their portfolio, but also understand them and act upon them. And we think the timing of the report is very good. It's coming out just as we are getting ready for the Paris meeting. The report tries to answer three questions. How big is the risk? What is the impact we are talking about on our returns? And it shows that it will be impacted no matter which scenario we're talking about, no matter if it's a 2-degree world, a 3-degree world, or a 4-degree world. It shows that investors cannot ignore climate change. They need to change behavior in their portfolio. The coal industry is, of course, no surprise, one of those industries that are really going to be hit. And it estimates that it could lose value of about 2% per annum for the next 10 years. The asset classes, the impact on asset classes, it will also be material, but that depends a little more on what kind of risk scenario we're talking about, if we are 2-degree or a 3-degree. But it does show that the climate-aware investors that actually takes this into consideration will be able to protect his portfolio. It shows that a 2-degree scenario does not necessarily have a negative impact on your portfolio as long as you are
diversified and you have a long-term investment perspective on your management. So what are the key risks that the report identifies? It's primarily the structural changes that investors are not prepared for. And that will be, for instance, the energy sector, where we will see a shift from the fossil fuel industry to alternative fuel industry or energy supply. And if they are not prepared for that, they will take a hit. It is also the higher physical damages that we're already seeing with the extreme weather events, for instance, that are pretty costly for the insurance industry primarily, but it does hit investor portfolio too. So what can they do? What should be the plan of the action of the investor? So the first step would be for the investor to have an opinion about climate risk, have it integrated in their investment strategy, have an operation in the way they have it integrated in the way they manage their portfolio and monitor their portfolio. It will be tracking the sensitivity of its industries and its asset classes to carbon. We have seen initiatives like the portfolio decarbonization initiative, which is basically tilting your portfolio to the less carbon intensive industries. It was an initiative spearheaded or launched by the Swedish pension fund AP4 and the fund manager Mundi. It is also a question of be aware where are your exposures and reposition your portfolio accordingly. Divestment has been mentioned a lot as one of the ways to do it, but it's not the only way to do it, and it can be a very costly way to do it. In addition to active portfolio management, there is also an engagement that needs to happen, an engagement with the companies that they are invested in, and an engagement with the asset managers that typically on a day-to-day basis manage the money. It is a conversation to be had about what is climate risk and what does it mean for their operation. Do they track it and do they report on it? And finally, there is the engagement with the policymakers. It is to have a dialogue on what does it need to facilitate the investment flows that we need to flow in order for a 2-degree world. It is helping the politicians shape the regulation. So moving on to the, well, maybe I should add, because that's actually an interesting piece of news. Mercer, who led this study, actually came out last week. Their chief investment officer came out and said they are going to take this on board. Mercer is primarily known to be an investment consultant. It's a global investment consultant, but what is less known is that they actually manage a portfolio of $100 billion. So they are going to take on board the learnings from this report. So as Michèle said, green bond is actually just a fixed income asset with a green addition. There's nothing fancy about it, but it's by having the green addition, it becomes an investment opportunity for an investor that wants to green his portfolio or just shift it a little towards a more green world. The World Bank issued the first green bond, its first green bond in 2008, and it was actually on a request from Swedish pension funds that came to the bank and said they wanted a AAA rated liquid fixed income product with a climate component. So the bond was created in collaboration with the Swedish SEB Bank, and I could say the rest is history, but there is still more to build a market. As Michèle also mentioned, IFC issued its first 1 billion bond in 2013. Actually, not just one, we did 2 that year. And in the meantime, we are now, the bank is at 8.5 billion in 18 different currencies. IFC is at 3.7 in 9 different currencies. The fact that there was issued 2 1 billion bonds helped to improve the liquidity of the green bond market and helped to solidify it. But there was also an increasing need for setting a practice, a best practice about what is a green bond and how do you establish a green bond. So a group of investors, bond issuers, and underwriters got together and created the Green Bond Principles, which is basically, you could say, qualifying what does it take to make a bond. Back a little later to what is the principles of the green bond. So IFC's Green Bond Program was launched in 2010, and it's based on IFC's definition of climate-related business. As I told you, we have a policy about we are investing up to 20% or more of our portfolio into a climate-related business. But in order to actually track that, we need to have a definition of what is it we call climate-related, and that's set out in the publication called IFC's Definition of Metrics and Metrics for Climate-Related Activities. That publication and those guidelines are defining in our portfolio which ones are climate-related. And the green bond eligible projects, which can only be loans because you cannot do a green bond on equity or the guarantees, but it defines the portfolio from which we will pick projects that are eligible for green bonds. Another key component of IFC's program is that we need to have very specific criteria for the evaluation of projects, but also the selection of projects. And we need to have a third-party opinion about that this is actually what we're doing, and this is how we define green and how we see green. The transparency around how we are doing it is also very important. And the management of the money coming in from the green bonds, they need to be ring-fenced to make sure that they are only used for the green projects. Finally, there is a reporting requirement on green bonds that we do an impact reporting on what have they actually achieved, what kind of carbon emission avoided has been achieved through the green bond financing. The two major sectors or industries under our definition of climate-related activities is, of course, renewable energy and energy efficiency. And you can see that on the green bond too. That's also where the major chunks of the portfolio is. I have put up this slide which show you the green bond process, but it's really not that different from the traditional investment decision process and approval in IFC. Where it differs is in step 3, where you will define whether this project is eligible for green bond funding, and in step 8, where the disbursement happens from the green account, which is the ring-fenced money from the green bond. And then finally, there is a climate report or an impact report in step 9, but that's also for the overall IFC portfolio that we supervise all our projects. The only difference is that for green bond funded projects, there will be a separate reporting on it. As promised, I was to come back to the Green Bond Principles, which was established in 2014 and was recently revised in March 2015. And then they will be reviewed annually and they will be updated as the market evolves. But it's based on 4 principles, and you will recognize the 4 principles from what I told you about IFC's program, but also from what Michèle mentioned. It sets out the requirements or the expectations around use of proceeds. It sets out the requirements about process for project evaluation and selection, and it sets out the guidelines for management of proceeds, the ring fencing of money, and the reporting requirements. As mentioned, a green bond is basically just a bond that has something green, but it meets some of the investors' needs. It meets the risk rating, it meets the liquidity of an asset, and it has the green component in addition to, did I mention liquidity? I think I did. In any case, what you can see here is that the typical investors in an IFC green bond is the asset managers. They are the big chunk, but the asset managers can actually also be investing on institutions investing as the major part of it. What we have seen in this space is that investors are increasingly interested in impact reporting, and they want to follow the projects they are tracking or invested in, and that is the reason why IFC, together with the World Bank, EIB, and the African Development Bank, has developed a harmonized framework for impact reporting. It was launched as a working paper in March this year, and the World Bank and IFC are currently working on issuing their first impact reporting using this framework. Having talked a lot about the technicalities of a green bond, maybe I should look a little to a project that we actually did using green bond money. And as we saw, renewable energy is the major part of our green bond business. So I chose a solar project in Chile. It's a 100 megawatt power plant. It is a total project of about 270 million, where IFC has financed 65 million US dollars. It is also a project where OPEC is involved. So the impact of this project is, of course, that it has increased Chile's renewable energy output, but it has also reduced the overall GHG emissions in Chile. And it has demonstrated the financial viability of a power project, a large power project with PPA without feed-in tariffs. Should I move on to talk a little about the future? As we have discussed today, the market is still dominated by AAA user proceeds bonds issued by multilateral development banks. We would like to see a change where it moves to revenue-based or asset-backed based bonds to move it off balance sheet basically. We would also like to see a development of new and local markets. We have seen interesting developments in China. We have seen developments in India, and Brazil is coming along. There is a lot of interest about it. There are some needs to get those markets to prosper. Some of it could be credit enhancement tools, which we have used in a case where we had a corporate issue in Indonesia, where we provided a guarantee to the company, so their credit rating became triple B. It could also be issuing in local currency, which IFC has done in 9 different currencies. And one of them recently was in Peru and sols, where we issued a bond in Peru, enabling the Peruvian insurance industry to invest in the green bond. So this is a lot of information that I've given you in a short time. So let me just sum up. Climate change will impact on values and investment returns. Investors need to take this into consideration. Green bond is an opportunity to invest in because it has the green element that will allow them to tilt it. So I think that will be it from my side. Thank you.
That's terrific. Thank you very much. Thank you both, Berit and Anurag. It's a lot of information. And are you asking me? Aha. So I'm looking forward to asking some questions myself. I'm sure you guys have questions for one another. And we'd also like to open it up to the audience after. One thing we haven't really focused on as much, although we've been talking about it, is the private sector. So green bonds are a way that we can be bringing in private sector money to then invest in different climate change activities or green activities. Some people ask whether it's additional money. I think it is, and even if it isn't, even if the private sector is investing in other bonds, for them to switch over to green bonds, it's a redirection, at least, of investment towards a greener economy, towards a lower carbon economy, towards adaptation, towards all of these different things that we've been talking about within CEADIR. So one thing that both Anurag and Berit have been talking about is risk mitigation and credit enhancements. And so the thought is, how can the development community and government and public finance come in to really leverage the private sector money? And we've got, Anurag, you were talking about how you can lower the cost of capital for the private sector developers, but then also enhance the credit rating for the private sector investors. And so in India, what are you doing also because part of what you were talking about was getting the word out to everyone about green bonds and what is needed, and this as an opportunity. What is USAID doing out there, or what do you see that India is doing?
Okay, so USAID in India is working on three things. One is basically helping the Indian financial institutions to understand this instrument, how it really functions. And that is where what we're trying to do is we're going to work with a number of financial institutions raise a bond through kind of international issuance. So this will help in two things. One, that these financial institutions will understand the whole process. They will also understand the process of getting their bonds rated, because that's again going to be an issue. But then also going to help them understand the issue of, because a lot of them really question, why should I lose my good projects or operating projects to a green bond, and then I'm kind of left with the projects which are under development or kind of are high risk, to help them understand how they can kind of reflow that money and get a kind of a better return out of their investment rather than doing it. Working with government, as I mentioned before, we are helping government to understand the impact of creating kind of a hedging facility, which can be used by different bond issuers globally, and where there will be any impact if we really look into a long term, like 10 to 15 years time horizon. So we did the analysis of the exchange rate fluctuation for last 15 years and see that if we had to do this kind of facility in India, will there be a kind of any outflow from this? And we found that there is not a major flow from this Swiss facility if it is created. So this is going to be one way to support that. And the third thing is for the financial institutions as well as project developers, depending on who is ready to kind of raise these bonds, to understand these principles of green bonds, because that is again something, as things are moving, they're changing fast. I heard that in March this year they again a change. So keeping them with the latest what is happening globally is going to help.
Yeah, the green bond principles, I think that is a key element, and we were talking about standards, and so Berit, thought on that in order to make this a clear investment for investors?
I think it comes down to the investor demand. I think there is a demand for different nuances of green. But I think we will be moving eventually to something that could be called a standard or common practice around what we understand by green. I don't think we'll ever be able to agree on what green is, but I think we'll see more standards as the market develop.
Mm-hmm. Now, I think you mentioned to me that somebody was looking at like deep green versus
That's true.
Green
there is,
versus...
and it's actually CEADIR who has opined on IFC's green bond. They recently launched that they are going to do a 3-tier on their opinions on green bonds. It's a dark green, it's a middle green, or it's a light green. I haven't seen any of those ratings come out yet. I haven't been able to figure out how they actually intend to do it, but I think it's an interesting development.
That's great. So we have through our webinar, we have a number of listeners as well, and I just wanted to let people know the countries that have called in, and that includes New Zealand, Guatemala, Turks and Caicos, South Africa, Chile, USA, Kenya, Belgium, UK, Jamaica, Mexico, India, and Denmark. So we've really got a global audience here, and both from countries that have already issued some green bonds and some that are also looking towards that. So I'm excited to hear what their questions are. Before I turn to the audience, I wanted to ask you, Anurag, and you, Berit, what you see as the most exciting part of your work that's coming up related to green bonds.
So I think for us, we are moving ahead, working with some of the financial institutions. I'm not naming them here, but there is a significant interest, and I hope that in the next couple of months we'll see the first international bond issuance from India.
That would be terrific. And how about you, Berit? What do you see? You're doing so much, but do you have a particular item that's
I would say
exciting you?
I'll take the institutional aspect first, the institutional investor aspect. I think the report that came out has really opened an interesting debate. We saw 12 big asset owners sending a letter to the G7's Minister of Finance that they wanted an ambitious agreement in Paris, and the whole run up to Paris, and see how the market will come together, hopefully, on an agreement, both on the political side, but also among investors. When we are talking about green bonds and what's exciting in that space, it's definitely to see how we can develop it into other types of green bonds, like the asset backs, how we could, for instance, make pooled bonds where you have, we called it the warehouse model, where you have a number of smaller projects that you eventually pool and then securitize into a green bond.
Great. Well, I'm going to give others an opportunity, and will anybody in the room? We'll start right here, and then.
Yes, for the issues where you have small. Hi, it's Chris Troy. I'm from Power Africa at USAID. So in terms of working with some of the smaller projects, a lot of bonds are more useful for larger projects. But when you have smaller off-grid projects or even grid-connected solar, wind, what have you, is there analysis showing that some of these pooled methods might come around sooner rather than later to really help that along? Because it's obviously it's a big issue trying to fund these tiny projects.
I don't know if it was to me, but I can do it. Yeah. It is what we call the warehouse problem, because we are thinking of how we can do it, but we are still in the drawing phase where we are figuring out how can we actually warehouse these, because until they are ready to be securitized, they need to sit on our books. And do we have the capital to do that?
Well, it's the management of the projects it's the management of the projects as well, too, when you have a
if we are talking about these micro projects, it's a totally different ball game.
Right.
Yes.
Yeah. And then also another, I guess, sort of related question is, when you have like all of these energy projects that take a really long time, are there more possibilities of issuing zeros when you have cash flows becoming much later, especially when you have technology sectors like, say, geothermal, where the revenue or the cash flows aren't going to be coming for quite some time? Are there zeros being, are zeros coming along in the market as well too?
I have not heard of zeros coming along in the market, but that would be more of an issue if it's really a project financed green bond versus the general asset back, right? Because the flows, the cash flows are not necessarily what's feeding off the bonds for those projects. So that's the way it's been handled now. And there's so many innovations that we still need in this, but we don't have, there are no zeros out there now. There's also a question here.
Eric Hyman, USAID Economic Policy Office. Related to that, is there a minimum dollar value that would be the smallest size for a green bond that it would not be aggregated but could be sold directly? And then question, does the IFC incorporate a social cost of carbon and economic analysis of projects?
That was a joke.
Well, I heard that the World Bank was going to be, so I wanted to know what the IFC's plans are.
So let me start with the first one. So I think there is a rule of thumb, at least in IFC's shop, that 250 is probably around what we do for a green bond.
150
million.
Yes, yeah. It can be done as a smaller thing, but it also comes back to who's the client, and if we're talking institutional investors, ticket size is actually very important for them. On the social, what did you call it? Social pricing of carbon. Well, it's a one world and it's a one World Bank group. It hasn't really hit on the radar screen in IFC yet, but we'll see.
Very good. Are there questions from our webinar viewers that I should?
Yes, quite a few actually. I'll start with Janardana Anjanappa. Why has the transport sector been able to raise high green bonds? Why not the water sector? And what are the sector limits in issuing green bonds?
So the transport sector, a lot of those have been climate-themed bonds and not necessarily labeled as green bonds. And it's because of basically the large corporations that are working in transport. Some of those agencies are well known, have good ratings, and have been able to issue bonds based on their earnings to then finance new projects. And those projects then happen to be in, let's say, clean transport. With water, I think there's more of a question as to who would do the issuing and what money are they backed by. And that's one reason. I don't know, you were mentioning that, was it the Netherlands had tried to issue some? And
Yeah,
some
there was,
difficulties?
there's one of the Dutch pension funds that are very focused on the water industry and the water sector, and they had been looking into the blue bond, but I'm not aware of where it is right now. And I agree with you, it depends on what kind of water we are talking about, because it needs to have a certain size, and it needs to have a certain liquidity in order to be green bond eligible.
Right.
Okay, and building on that question, actually, maybe for Anurag, which are these sectors in the context of India?
So in India, I think at this moment the green bonds are largely focused only for renewable energy projects, and I haven't seen that there is any interest from other sectors looking into green bonds. But
In Africa, and if yes, which sector and what is the scale of investment?
So we don't have a green bond called Green Bond Africa, but there will be African projects within our green bond portfolio. I don't have any statistics on which countries or the size, but it will probably be in renewable and energy and efficiency.
Hi, my name is Avril Benchimo. I work with the Inter-American Development Bank, and my intervention is a little bit more to answer the warehousing part that Chris was asking, and also on the very exciting moments that might be coming for the green bond. The IDB just responding to these challenges of very small projects in energy efficiency, just closed a transaction, a two-part transaction, in which, first of all, you need to do the warehousing, as Berit was mentioning, in which we finance through a loan or a facility energy efficiency projects of very small scale in order to standardize them and accumulate them for, in a second phase, then issue in the local capital markets. So that's the way we are kind of envisioning this type of warehousing, and not only in our books or like in the IDB books, but through SPVs set up locally. So that's where we're seeing a little bit of more movement and more appetite in developing countries in Latin America.
Can I follow up on what you're saying there? So I understand the IDB in Mexico is actually working in the energy efficiency area in this, and they're looking, and as you said, with a lot of different projects, they're looking to get the receivables and then to securitize those and issue the bonds. Do you know any specifics about that particular deal? And I know they're working with ESCOs there too.
Yes, this deal specifically is basically building up special purpose vehicles that will finance, or that would be the borrowers of the IDB loan, that then would on-lend to the ESCO, energy services companies in Mexico, to do the energy efficiency projects at a very small scale. The way the borrowing is going to take place is discounting the account receivables of future energy savings. And the way this needs to be done, it's in a very standardized way. So there's a lot of legal costs and standardization of the project, so that in a second stage, once the SPV has accumulated a lot of these account receivables, those can be securitized and issued in the local capital markets. That's how we are structuring the deal.
Great, thank you.
Zephyr Taylor, Clean Energy Advisor in USAID's Climate Change Office. I'm curious what your thoughts and perspectives are on the role that national and regional development banks in the emerging markets themselves can play in a potential opportunity for them to expand the green bond market in terms of channeling it towards climate-friendly investments.
Everybody looks at me.
I,
So you mean develop the domestic market? Yeah, so what we already see, and what IFC is also doing a little of, is there's no limits to that we can only issue green bonds. We can actually also invest in green bonds. And that can help build that market, the local market, by providing the credibility of the green bond.
and those national development banks and regional development banks can also purchase green bonds, and that's a way that the governments are looking at increasing the liquidity and the market, the demand in the country. And because once they invest, then other investors see that it's a reliable investment and will jump in. And especially if IFC, for example, partners also buying with some of those national or regional development banks in the country, then everybody wants to jump on board.
We have another question from our webinar audience. From Michael Fisher, what has been observed so far as a debt cost advantage, lower interest rate, for green certified climate change project bonds? What is the estimated cost of obtaining green bond certification?
Interesting. So there are two questions. You were dealing with the cost of capital, right? So
I think cost of rating and issuance varies depending on the size of bond and where it's issued. I think from our assessment, it is 0.5% of the total issuance. If it is like up to like $200 million, that's a medium size one is looking into. In India, our analysis is showing that the cost of green bonds is around 13%. And the cost of debt which is available through banks is also at the same rate. So it is not really giving you the advantage of lower interest rate, but it does give you the advantage of a longer duration loan which is available to you. One other analysis which I think is kind of useful to share is the advantage it brings to a project developer. So if a project developer has to decide between a local debt which is available at 13% versus a green bonds which is available at 13% but for a longer duration, it can free up some of the cash flows for the same developer. And if you have more cash flows available to you, you can reinvest that money as equity for a new project development. So our analysis is showing that a same investment by a project developer can be enhanced, and they can kind of increase this business by 30 to 40% if they were to go for a green bonds, which is for longer duration, versus a same interest loan from a project from a bank in India.
So the other part of the question was the cost of certification. I don't actually know how much it costs to have a third-party certifier. I do know that there are more certifiers entering the market, more third-party organizations that are starting to do this, which in theory should bring the price down just because of competition. Berit, do you know anything about the cost of certification?
No, I don't. But it is touching upon a problem with the green bonds is that the IFC green bond sells at the same price as the plain vanilla IFC bond. We don't get any extra money for it. And there are some additional costs to a green bond, and that's not just for IFC, that's for every green bond issuer. What it does do, however, is that it taps into a different kind of pot of money. It taps into a responsible investor crowd, and you suddenly have another liquidity.
Okay. We have another question from Glenda Lee. How involved are the speakers with Clean Bond Initiative?
Clean bond?
Clean Bond Initiative?
Climate Bond Initiative, maybe?
Perhaps so. Okay.
Yeah, Climate Bond Initiative. Sean Kidney runs that out of UK. Definitely a good source of information. They're tracking the labeled green bond market. In fact, going online towards to look at their information, they have reports on the market every year. They have a blog on new issues. So, and they're also involved in creating standards. They have their own standards that they're trying to develop right now. I know Eric had a question.
I was wondering, Eric, I'm in USAID Economic Policy Office. I was wondering if CISR has already developed those criteria for green versus deep green versus middle green, and whether those are publicly available.
So they launched it in March at the Green Bond Principle Conference. I've tried to find more information about it, but I think it's their intellectual propriety. I have not been able to really dig it out yet. So.
Sort of a general question. As the externalities pile up in terms of like fossil costs, when you look at, I saw an article recently, and I didn't read into it, about one of the largest coal producers not being able to cover the cost of cleaning up after their tailings. And when you look at all these externalities, so like fracking, and who knows what the costs are going to be 10, 20 years from now, cleaning up after all that. Why is it that the green market can't do a better job of looking at the actual cost of these and showing that it's actually super competitive?
You mean the price of the green bond?
Yeah. So that if you look at, say, if you use like a system dynamic framework where you look at the cost circling back after a decade or so, show that economically it really just makes sense. Is there a reason why the green market can't do a much better job of marketing that?
I think this is going a little beyond the green bond, but I think it actually comes to putting a price on carbon, which is not there. There's a lot of negative externalities that are not priced. And as long as they're not priced, it's very difficult to come and claim as green that I'm cheaper, because there are some that are not paying their dues.
I think there's an analogy with, like, say, with cars too. So if you have these little electric cars you plug in, be saved, then you have Tesla, that suddenly performs much better because it actually gives you the performance that a driver wants, and it's electric too. So you can show that there's actually a real difference. So there's an economic difference, I think, that's probably there. I don't think it's being marketed well. But suppose the carbon cost hasn't really been fully sussed out yet, so that has to be developed more. But are the researchers currently working on that to actually tie in the economic benefits better?
Well, with regard to the environmental economics and climate economics, I mean, that is a field that's growing, and in fact, that's what the CEADIR project is doing, that in a number of different countries, and it's getting more market acceptance and also the word out on those costs. And so as you say, yeah, there are the carbon costs, there are the other externalities like air pollution. And so when we're looking at any project, we're looking at what they call the co-benefits of that project. Now the green bond is a way to finance those projects, but the green bond is not necessarily the issuers of the green bond are not necessarily the ones that need to do the research on the actual target project. The target projects also and other and that's also an area for policymakers and others in this community, in the development community, should be doing that research, getting that information out so people understand the benefit, all of the benefits of that particular technology and the economics. I mean, including those externalities has been an issue for a while in a number of fields, and when we look at RED and all of these different fields. So I think it's really a wider audience that needs to be looking at that. And then it's public education, both for consumers and for investors, and then also for policymakers. It's, you know, it's the whole, it takes a village kind of concept there. And then the green bond will be a financing tool to then target those types of industries.
It ties back to the whole discussion about sustainable investing. Can it actually make sense to invest green or environmental and socially correct? And there have been a number of studies out there, and I think it's about 50-50 on whether it makes sense or not. I've done a little study on our own internal portfolio and found out that it actually makes a difference, a positive difference for our portfolio. But you will find equally many out there saying it doesn't make a difference, and the additional cost to do that doesn't make it worthwhile.
Do you see that changing in the future?
I think it's changing, yes.
We have another question from our webinar audience and some interest in the answer to this one. How relevant are green bonds as an instrument for small developing countries or islands? Seems like the cases being discussed are pretty huge funds for huge projects, which is not the case for small markets.
Well, I think that's the case where when you do have these international development banks and other issuers, the money that they raise from green bonds can be going into projects in different countries, in different small countries. And so it may be more difficult for, say, a small island developing country to issue its own bond at size. They could also group with other surrounding islands, for example, and have a regional bond. And that would be a way to aggregate and then issue.
We have a question about Mexico from Enrique Robadelo. Many countries like Mexico issue debt bonds every day, debt or bonds every day. What are the barriers to redirect these bonds to climate or green bonds, and particularly develop a portfolio or criteria to be funded by them?
What the use of proceeds was described as being. And so whoever's invested in those bonds is expecting the money to go into certain types of investments. If it's open, there's no reason why that money can't go into different resources. But I think the idea here is to be issuing these types of debt obligations. And as this participant said, you know, there are a lot of debt obligations out there. So the issue is more labeling it and having a defined purpose for it so investors can choose that investment. I know we have a question right here.
So, hi, Alan Miller with the CEADIR Project and XIFC. An observation and a question. The observation is that if, as projected, climate bonds approach, or green bonds approach $100 billion a year, that is not coincidentally on the order of the climate finance objective for 2020. So my question is to link the use of climate finance, which Anurag, you just briefly in one tangent mentioned, but it would seem to me that among the more interesting potential uses of climate finance would be attempting to address some of the barriers that you described. And in particular, IFC has been associated with a recent proposal from the Global Innovation Lab. I don't know, Berit, if you were involved with it, but IFC Treasury helped prepare it for a hedge swap instrument that would be supported by climate finance as a facility. And a second proposal that IADB was involved with is addressed to creating a facility to address smaller farmers that would be an adaptation related product, which is completely outside climate bonds so far. But it illustrates at least one mechanism to try to standardize and warehouse. So I'm just curious if you have any further insights into the evolving prospect for using climate finance more effectively in this market.
So I think thanks, a very good point. We also looked into this, and I think the basic issue is the availability of climate finance, and whether that amount is really up to the mark, and that is kind of helping us to achieve the climate targets which we're looking into. It doesn't. So we really need to use these funds in a best innovative way through which you can leverage other investments. And one of the idea which we thought by using climate finance for credit enhancement, or maybe creating a hedging facility, going to be a better use than kind of using it directly for a climate project.
One last question, actually, from our webinar audience. How do you avoid greenwashing of green bonds and ensuring certain levels of sustainability?
That goes back to the principles that we've been talking about. And although right now the green bond principles are they're voluntary guidelines, the more investors are going to start insisting that issuers follow those principles, and then it also comes back to the standards and having maybe third-party certification in the beginning, but also once an issuer has been certified, that framework can continue more easily on following issuances. Once investors gain trust in an issuer, then I think it will be like we've talked about ratings, sovereign ratings, et cetera. Issuers will have certain ratings perhaps in the green bond field. I don't know what you think about preventing greenwashing.
No, I totally agree with you. It is the role of the principles. It is to create the integrity of the market and the transparency what it will take. I think you are right about the opinions that when you get a credibility, you have one opinion that kind of covers all your issuances, depending on what kind of operation you are normally. Because we have also seen oil companies trying to issue a green bond, and that suddenly raises some questions about what is green, because is it green that the bond is used to finance green projects, or is it green because the operation in total is green?
And then monitoring, that'll be an issue for these projects, especially the ones that are particularly backed by projects, to see how those projects are proceeding, or to see what the use of proceeds actually has been, and to monitor that will also be a way.
Okay, well, thank you. It's been very informative. And I just wanted to add a little bit about CEADIR. Go to the last slide there.
Oh, sorry.
But part of the objective of CEADIR is that we are going to be talking about adaptation, clean energy, sustainable landscapes. And today's talk has been a fair amount on looking at energy efficiency and renewable energies, the mitigation side of it. But I think what's also exciting is how, and Ellen just sort of referred to this, how are we going to start to use green bonds for adaptation too? And I think that's a growing area of interest to find out how we can create those instruments. But also having said that, CEADIR has a real interest in not only looking at green bonds, but looking at a variety of different instruments. And what we're looking at in CEADIR is to create a certain set of financial tools, if you will, and we often call it a clean energy lending toolkit that we did for a former project. Right now we're looking at climate financing toolkit too, and Ellen and some other folks on the team are going to be, and Michèle, going to be helping to our panelists right now in creating an application or toolkit that really allows you to look at it, the financing of energy mitigation and or adaptation from the financier's perspective. So you're really getting a handle on it to, if you go in and you can make it iterative, you can make it dynamic, you can start to say, we've got this set of portfolio projects, might be mitigation, adaptation, and we want to be able to figure out what type of good financial instruments might be used with it too. So we're looking at a little bit different perspective too. So keep tuned. And also there's the next presentation. I don't know if we have that up there too, but the next presentation that we go to in July 14th, will be on mainstreaming Laird international planning. I think we've changed the name a little bit more to applying and looking at the implementation of Laird's programs too. So please keep with us, those who are on the webinar, those who are attending. We're looking at a July presentation too.